Hey guys, how's it going? Matt Druin here. A few times in the past couple months, I've been asked several times by investors and also people that have an interest in real estate as to, Matt, what's your take on the market in the 11th year of an economic recovery? The market crashed in 2000, 2008. We have been in recovery since then. So being 2019 right now, economic recoveries do not last forever. So what I've been finding locally is in my investor groups is that there's been a lot of what I call investor fatigue that I've seen out there. It's a lot of active investors that are sort of putting the brakes on, just being exhausted from a lot of deals and a lot of work they've done over the past year, and just being like, listen, I'm just going to sit back and wait a little bit. I need to catch my breath here. Prices have gone way up. I'm having a hard time finding deals out there that make any sense whatsoever. So I'm seeing that amongst a lot of active real estate investors. Now, Rochester, we have a small town, so there's only probably maybe between 50 and 100 full-time real estate investors. So if they're all sort of saying the same thing, then it's a good pulse on the local market. So that's it from a local level. I underwrite deals every single day in terms of running numbers, and it's been a hard time to find deals that make sense. Regardless of the market cycle, there is a deal to be found in any cycle. So I have been buying aggressively over the past 3 years, but the deals have been fewer and far between. And the ones that I have found have been great properties, but they haven't been smoking hot deals like we all like to brag to each other about. We've been buying great properties for a fair price. So that's our pulse in the market locally. On a national level, I've been doing a lot of traveling over the past couple of years. I've been seeing a lot of, I'm just looking at my notes here. I've been traveling to secondary and primary markets, markets like New York City, Toronto, Boston, Seattle, and seeing a ton of construction going on. There is, my wife and I were in Seattle, I think it was it was over the summer, and there was so many cranes. I've never seen so many cranes in my entire life. When you see cranes in a real estate market, most investors that are value investors say run. Data that I've been seeing in these markets has been suggesting rising vacancy rates amongst residential and also commercial retail office product. So that's what I've been seeing on a national level, just from a construction standpoint. And then one of the most telling signs I would say is I don't follow the stock market that much. I do follow the bond market. Number one, we as investors use bank loans to purchase and develop real estate properties. So interest rates are very important to that function of the business, the financing. And then secondly, it is the bond yield curve, what the 2-year, 5-year, 10-year, 30-year treasury bonds trade at in terms of what interest rates they trade at, is a very good leading indicator as to what the economy is looking like it's going to do. So I'm going to show you through a couple illustrations, some weekly illustrated drawings that I have as to what a normal yield curve looks like and what our current yield curve looks like, just to express to you as to my concerns. It looks like we are getting close to an inverted yield curve. You don't need to understand the mechanics of this. You can just Google bond yield curves and educate yourself on them, but this is something that is of a particular concern of mine, I should say, and something that you should probably be following if you're looking at trying to at least read the tea leaves and make some type of prediction. But predictions aren't worth anything. I thought we were going to be in the 8th inning of this economic recovery 3 years ago. So anyways, I'm going to show you what the yield curve looks like, and hopefully learn something from it. So bond yield curves. This is what a normal healthy yield curve looks like. Basically what you need to understand is that when you loan out money, this is right here on the maturity level, right here. When you loan out short-term money, you as an investor expect to collect a lower percentage interest rate. You're taking on less risk by keeping your money locked up for so long. When you get into 30-year treasuries, 30-year bonds or loans, the interest rate is higher because the investor in that loan is taking on more what's called interest rate risk. So this is what a normal yield curve looks like. As you can see, it kind of looks like a little hill. It makes sense that this is what a yield curve looks like. Why would you loan out money for 100 years at 1% interest when you could loan money at 30 years for 2.5% interest? Okay. Right here is kind of what we're looking at right now. We're in a flat yield curve environment. It's slightly inverted around between the 2 and 5 year treasury yields. The 2-year is actually trading a little bit higher in terms of percentage points than a 5-year, which is sort of the vanguard for the start of a correction in the markets. And I think if you're looking to be speculative in this part of the market cycle, you're going to have problems. Regardless of which market cycle you buy in, you will be protected by the length at which you can weather the storm and hold on to an asset. The longer you hold on to an asset, at some point in time, it will appreciate regardless of which market cycle you buy it in. So don't have any fear, but just be more cautious. Don't give in to emotional type buying decisions, and you don't need to stay on the sidelines. You can still go out, look at deals, look and crunch numbers on deals, educate yourself, and wait for the right opportunity to come. And if you want to know what that right opportunity looks like or my opinion on it and what I like, you can always reach out to me for a conversation. But either way, I hope this has helped you as this helped me. Have a wonderful day.